Hello fellow traders. In this video we'll discuss strategies for identifying undervalued companies and building positions in them. We'll also explore techniques for managing risk and adapting to market conditions. By understanding these concepts, you can make a more informed investment decision in the markets. Understanding value. Fundamental analysis focuses on a company's financial health, including its earnings, revenue, and debt levels. Technical analysis uses charts and indicators to identify trends in the stock price. A combination of fundamental and technical analysis can help you identify companies that are trading below their intrinsic value. There are two main approaches to evaluating a company: fundamental analysis and technical analysis. Fundamental analysis involves looking at a company's financial statements and other metrics to assess its long-term health. Technical analysis involves using charts and indicators to identify trends in the stock's price. By combining these two approaches, you can develop a more well-rounded understanding of a company's value, whether it's currently undervalued. If this video connected the dots with you, give it a like. Share this video with other traders looking to improve their trading game. And what market topics do you want to discuss next? Consider subscribing for more Market Edge videos. Let's get back into it. Building a position gradually. Don't try to time the market perfectly. Invest a set amount of money at regular intervals. This approach helps you average out the cost of your shares over time. It also helps you avoid investing too much money at once, which can be risky. When you've identified an undervalued company, it's important to build your position gradually. This means investing a set amount of money at regular intervals, such as once a month. This approach is known as dollar cost averaging. It helps you average out the cost of your shares over time, but it also helps you avoid investing too much money at once, which can be risky if the stock price suddenly drops. So use a lot of caution in these types of strategies. Writing covered calls. A covered call is an option strategy that allows you to generate income from your shares. When you write a covered call, you agree to sell your shares at a certain price by a certain date. In return for this agreement, you receive a premium. Covered calls can help you reduce the risk and generate income. A covered call is an option strategy that allows you to generate income from your shares. When you write a covered call, you're essentially agreeing to sell your shares at a certain price, the strike price, by a certain date, the expiration date. In return for this agreement, you receive a premium. Covered calls can be a useful tool for reducing your risk and generating income. However, it's important to understand the risk involved before using this kind of strategy. Rolling contracts into shares. When a covered call is about to expire, you have three options: allow the contract to expire and sell your shares at the strike price, buy back the contracts to close out your position, roll the contract to a later expiration date. Rolling a contract involves buying back the original contract and selling a new contract with a later expiration date. When a covered call is about to expire, you have three options. You can allow the contract to expire and sell your shares at the strike price. You can buy back the contract to close out your position, or you can roll that contract to a later expiration date. Rolling the contract involves buying back the original contract and selling a new contract with the later expiration date. This can be a useful strategy if you believe the stock price will continue to rise. Leveraging market psychology. Market psychology can play a significant role in stock prices. Investors become fearful or greedy, which can lead to overreactions. Understanding market psychology can help you to identify opportunities. Market psychology is the study of how investor emotions and beliefs can influence stock prices. Investors can become fearful or greedy, which can lead to overreactions in the market. By understanding market psychology, you can identify opportunities to buy stocks that are trading below their intrinsic value and to sell stocks that are trading above their intrinsic value. Fear of missing out, FOMO. FOMO is the fear of missing out on a profitable opportunity. It can lead to investors to making impulsive decisions. You can use FOMO to your advantage by identifying stocks that are generating a lot of excitement. Fear of missing out, FOMO, is a common emotion that leads investors to make impulsive decisions. When investors see a price of a stock rapidly rising, they may be tempted to buy the stock without doing their own research. You can use FOMO to your advantage by identifying stocks that are generating a lot of excitement. However, it's important to remember that just because a stock is popular does not mean it's a good investment. Bandwagon effect. The bandwagon effect is a tendency of people to follow the actions of others. In the stock market, the bandwagon effect can lead to herd mentality. Herd mentality can cause stock prices to become overvalued or undervalued. The bandwagon effect is a tendency to have people follow the actions of others. In the stock market, the bandwagon effect can lead to herd mentality, where investors buy or sell stocks based on what others are doing, rather than doing their own research. Herd mentality can cause stock prices to become overvalued or undervalued. It's important to be aware of the bandwagon effect and avoid making investment decisions based on what others are doing. Adapting to market conditions. The stock market is constantly changing. It's important to adapt or be able to adapt your investment strategy to changing market conditions. This may involve selling stocks that are no longer undervalued or buying new stocks that have become undervalued. The stock market is constantly changing. New information is changing, being released, and economic conditions can change rapidly. It's important to be able to adapt your investment strategy changing to the market conditions. This may involve selling stocks that are no longer undervalued or buying new stocks that have become undervalued. It's important to be patient and stay disciplined with your investment strategy. A quick detour. I've identified a couple intriguing companies with the potential for significant developments next week. I'm excited to share their charts and analysis with you. They are Fubo TV, Inc., ticker symbol FUBO, and CrowdStrike, ticker symbol CRWD. Charting of Fubo Inc., ticker symbol FUBO. With the deck still reshuffling with the media companies, I feel that this could be a value buy. It's installed in the devices and it's gaining traction. The average volume on this is about 9 million. The high volume of 58.87 million took the stock to the mid 2 area. This sold off in the high 3 area with about 62 million in volume. The average volume can reclaim the high 3s, but if it sells off, this can recover around 113. Charting of CrowdStrike, ticker symbol CRWD. This company has good cash flow, which gives them room to grow and opportunities to do other things like acquire smaller companies or invest more in their R&D. So they still hold good value in my opinion. This average volume on this is about 7.7 million. The high volume of 16 million took the stock to the mid 4 area. This sold off with 5 million in volume in the 390 area, which is about intraday Friday. So with the average volume, this can reclaim 390 or better. But if this sells off, this could possibly bounce at 370 or lower. Conclusion. In conclusion, this video has explored strategies for identifying undervalued companies. By building a position gradually managing risk and adapting to changing market conditions. So key takeaways are: apply these strategies with caution. And as always, importance of ongoing research. By understanding these strategies, you can make more informed investment decisions. However, it's important to remember that these strategies are not foolproof. The stock market is risky, and there's no guarantee that you'll make money. It's important to apply these strategies with caution and do your own research before investing in any company. You should also consider your own risk tolerance and investment goals before making any investment decisions. Finally, remember the stock market is constantly changing. It's important to stay up to date on current events and to be willing to adapt your investment strategy as needed. By following these tips, you can increase your chances of success in the stock market. I hope this video has been informative. Thanks for watching.